to the latest video with Money to the Masses. As you can notice, there's a bit of different scenery here today. That's because we asked you to ask any mortgage questions that you may have, because we're going to put them to a mortgage broker. So here we are, here we have Will, and I'll let him introduce himself to you.
Hi there, my name's Will. I'm a mortgage expert at Habito, and we're a free online mortgage brokerage.
Cool, so I've got all your questions here, so I'm going to fire them away at Will and then hopefully get all of them answered for you. Okay, so what's the best way to find the best mortgage deal?
I'd always speak to a mortgage broker. Mortgage comparison sites are great. However, they're not always going to tell you whether you're eligible for that specific product. Also, what lenders will do is they'll highlight their lowest rate, and that doesn't always take into consideration any fees that are associated with that product. So what your mortgage broker will do is they will work out which is the best product for you, based on what is called true cost. And that takes the initial rate, the monthly cost, it takes any associated fees, and they'll be able to show you which one is the most cost effective for yourself.
Okay, so as someone coming into the mortgage buying process and the application, you leave school, you leave uni, you might have been renting for 10 years and you want to buy a house. How much should you know before you go and buy that property? Because I know, even personally, I feel like if my friends are buying a house, I should know when they're talking to me about all these fancy words. I'm thinking, I have not got a clue what you're going on about, but you feel really stupid. So what do you do if you're someone who's ready to buy a house, but you feel like you don't know anything about it?
Honestly, don't worry. Mortgage brokers, mortgage experts are there to help you. I love my job and I love helping customers, and it gives me great pleasure giving them that information, educating them throughout the whole process. So no question is a stupid question. Ask as many as you like. It's a big financial commitment, so it's important you get it right and you understand it. So don't worry about it at all.
So another big one is, you all know that you have to kind of be cautious of your spending before you apply for a mortgage. So when they look at your bank statements, the lender, when they look at your bank statements, what are they looking for? Do they look at everything? If you've got multiple bank accounts, do they want 3 months or however many months of statements from each one, or sure. How does that work?
Look, start with your first question. What they're looking for is credit commitment. So that basically means credit cards, loans, student loans, any regular payments, so maintenance payments for example. I think it's really important to stress that mortgage lenders are not trying to catch you out. They're there to lend. However, they need to ensure that it's affordable on a monthly basis. If you've got more than one bank account, then it's good to provide those upfront, because as part of the application, a credit search will be done. So if you've got a loan and it comes out of another bank account, the lender will question that. And then it begs the question, are there other loans from other bank accounts as well? So if you have got them, it's best to be upfront and provide all that information.
And would you say if I had credit card debt or loans, it's best, if it's not a massive amount, is it better to try and clear them off before I apply for a mortgage? Or?
If you can, yeah. The more credit you've got outstanding, the less you'll be able to borrow. A small amount, and if it's paid off on a monthly basis, that doesn't matter. Lenders will factor that in, that it is cleared off on a monthly basis. But yeah, the less credit, the better.
Okay, so if I took out a payday loan 2 years ago, is that going to affect me if I go to apply for a mortgage?
It will. Lenders are more and more open to payday loans. However, it does reduce the amount of lenders that are available to yourself. So yeah, my advice would be, don't apply for any payday loans, particularly in the lead up to applying for a mortgage, and try and avoid them if possible.
Okay, so how can I ensure that I get the maximum borrowing amount when I'm applying for a mortgage?
Well, my first thought is that the best advice? Do you really want to get the biggest mortgage and potentially struggle with the monthly payments? So my advice would be, make sure that it is affordable, you're comfortable with the monthly payments. But if you've got any credit outstanding or any loans that can be cleared, then try and reduce those down as much as possible. I appreciate it's easier said than done, but if you can increase your deposit, anything over 25%, which is a huge amount of money, but that will ensure that you've got the maximum amount of borrowing. And also a term, anything over 25 years, that tends to mean that you can get the most amount of borrowing. However, there are a couple of schemes out there. Help to Buy is one, and also shared ownership. Help to Buy, you can get an equity loan from the government, which you can put towards your deposit, and then you get the mortgage for the remainder. So that can enable you to buy a slightly bigger property. And shared ownership, slightly different concepts, but you only buy part of the property, and then you rent the other part of the property. So another way you can get a slightly bigger property.
Okay, so how do I decide the best mortgage term to apply for me? Do I go for the longest term length, or how does that work?
I'd always recommend the shortest possible term. Let's be honest, no one really wants a mortgage, they want the property, so the quicker you can get it paid off, the better. But I can't stress it enough, it needs to be affordable. If you want to go for a 40-year term or a 35-year term, because that fits in with your requirements now, then yeah, go for it. One thing I do want to mention is that any terms over 35 years, it would restrict the amount of lenders that are available for yourself. So Halifax, Santander, they will offer 40-year terms at the moment, but it's not all lenders.
And would you say as well, if I took out a 30-year term mortgage, 5 years down the line, I thought, actually, I'm more comfortable now in my financial situation. Yeah. If I remortgage, I can reduce that term? Is that easily done?
You don't necessarily have to do it when you remortgage. However, when you do remortgage, you can assess the whole mortgage. So that could include the term, the fixed product, the borrowing amount as well. Lenders will allow you to change your term during a fixed period, but they may charge you an administration fee in order to do that. Another thing that you can do is you could keep your term as it is and overpay on your mortgage. That way you're not committed to making those higher monthly payments, and you pick and choose when you want to increase the payments.
So a lot of people have actually asked us, is it worth overpaying on your mortgage? Would you say that if you're financially comfortable enough to do that, is it actually worth overpaying?
100%. Yeah, absolutely. Overpaying is going to reduce the amount of mortgage outstanding, which means you're going to pay it off quicker and you're going to pay less interest. So 100%, if you can afford it, then do it. But one thing to consider, lenders, they usually have restrictions on how much you can overpay by. Most will allow you to overpay up to 10% of the outstanding balance per year, which is quite a lot. But if you're getting close to that 10% limit, then just be mindful, because there might be early repayment charges which are applied for those overpayments. When you get to the standard variable rate, you can overpay as much as you like without any early repayment charges.
Okay, so how do I go about accessing money that I've got in my property if I wanted to do home improvements?
So if you're tied in with your current lender, then I would suggest speaking to that lender. They can provide something called a further advance, which is essentially an additional loan which is secured against your property, like a mortgage. It will be on a separate rate. However, you can take out as much or as little as you need, subject to their affordability checks. If you're out of your deal, so you're on the standard variable rate, then you could apply to another lender, and you could take out what you need, assuming you've got enough equity in the property, and that's the difference between the mortgage balance and your property value. But always consider, do you need to take it out as a mortgage? Would a personal loan be better? That's not secured against your property. So it's factoring how much money you need and what is best for your circumstances at the time. Okay, so that's it for this week's video. Thanks so much for watching. I just want to say a massive thank you for sending in your mortgage questions. It's been a massive insight into the world of mortgages, and I hope that it's helped you find out everything that you wanted to know. Also, thanks so much, Will. Really appreciate you letting us sit down and ask you all the questions that everyone from Money to the Masses has had. So as ever, subscribe to our YouTube channel, follow us on our social media, our Facebook, Money to the Masses, our Instagram @Money to the Masses, and our Twitter @Money to the Masses with the number 2. Thanks so much for watching, and see you all next week.